For decades, a powerful undercurrent has been shaping global finance, often unnoticed by the average investor. It operates quietly in the background, yet its influence can inflate asset bubbles and trigger sudden market downturns. This phenomenon is known as the yen carry trade, a financial strategy that has become deeply embedded in the modern global economy. Its mechanics are straightforward, yet its consequences are complex and far-reaching. The strategy involves borrowing Japanese yen at exceptionally low interest rates. Investors then convert these yen into other currencies, such as the US dollar, to purchase assets that offer a higher rate of return elsewhere in the world. This difference in interest rates, or yield, is the source of profit. The trade's effectiveness hinges on Japan's long-standing policy of maintaining near zero, or even negative interest rates to stimulate its domestic economy. The significance of this trade extends far beyond the portfolios of individual investors. Because the Bank of Japan has kept borrowing costs exceptionally low for so long, it has effectively created a massive, reliable source of cheap capital for the entire world. This flow of low-cost money, originating from Japan, acts like a river feeding into the global financial system. It provides the liquidity that fuels investment and speculation across a vast array of markets. One of the most visible consequences of this abundant, low-cost capital is the inflation of asset prices, often referred to as a bubble effect. When borrowing is cheap, investors are more willing to take on risk in search of higher returns. This increased demand, funded by borrowed yen, pushes up the prices of various assets. These include mainstream investments, like stocks on major exchanges and real estate in global cities. The influence of the yen carry trade also extends to more speculative corners of the market. The rise of cryptocurrencies and the rapid growth of technology startups have, at times, been partially fueled by this flow of easy money. Emerging markets are particularly affected, as they often offer higher growth potential and, consequently, higher yields. This influx of capital can drive significant economic booms. But it also introduces a critical vulnerability. Beneath the surface of these seemingly profitable trades lies a significant and often underestimated risk. The entire strategy's profitability is contingent on a specific currency market condition. The Japanese yen must remain weak, or at least stable, relative to the currency in which the investment is made, like the US dollar. Investors are essentially making a dual bet. They are betting that their chosen asset will increase in value, and they are simultaneously betting that the yen will not strengthen against the dollar. A strengthening yen represents the primary trigger for a potential crash. If the value of the yen rises, the cost of repaying the original loan in yen terms increases, eroding or even eliminating the profits from the higher-yielding asset. Another trigger would be a decision by the Bank of Japan to raise its interest rates. Such a move would increase the cost of borrowing yen, making the carry trade less profitable and prompting investors to close their positions. When these triggers occur, the process of unwinding the carry trade begins. Investors are forced to sell their foreign assets, be it US stocks, European bonds, or real estate in Australia, to convert the proceeds back into yen to repay their loans. This is not a gradual, orderly process because the risk is systemic. A strengthening yen or a rate hike in Japan prompts a synchronized rush for the exits, as countless investors try to unwind their trades at the same time. This simultaneous selling pressure creates a powerful and rapid downward spiral in asset prices. What started as a trickle of selling can quickly become a flood, overwhelming markets with sell orders and causing sharp declines. The effect is global, as the assets being liquidated are spread across the world. A stock market in New York, a property market in London, and a corporate bond market in an emerging economy can all experience sudden downturns. Linked by this common financial thread, the central takeaway is that the movements of the Japanese yen are not just a concern for currency traders. They are a critical indicator for the health and stability of the entire global financial system. When the yen carry trade unwinds, it demonstrates how interconnected modern markets have become. A policy decision made in Tokyo can trigger a cascade of selling that reverberates across continents, causing what appears to be a sudden and inexplicable market crash.